We will go ahead and get started. Thank you for taking time on a Thursday to be here. It means a lot to have you guys here. And thank you to CoStar for hosting us. Just a couple quick words, kind of housekeeping stuff I want you guys to think about. Real quick, designees, if you guys would raise your hand real quick, the active designees in the Georgia CCIM chapter. Awesome. Okay. How many folks are currently taking advantage of the...
We're going to start.
Welcome in, guys. How many guys are taking advantage of the affinity benefits program? One. How many chapter designees are aware of the affinity benefits program? 3 or 4. Okay, what we're going to do in the next couple weeks, and I think this is important for you guys because you're paying for your membership, and this is for designees. We're going to send out an email with a link with the different member benefits you guys get as CCIM designees. Go have a seat. And I think it's important because you guys are paying money to be members of the Institute. You worked hard to get your CCIM designation, and there's a whole list of member benefits that you guys are entitled to as CCIM designees. So this, in the next week or two, you guys will be getting an email from us with a link so that you guys can go check out all the different member benefits that you guys get as members of the Institute. So just wanted to share that with you guys. So our program this afternoon will be moderated by Mr. David Kahn and Mr. Brad Raber. David is the Managing Analyst for CoStar Group, concentrating in the southeastern United States. David serves as the resident expert in the Southeast, covering regional economic and real estate trends.
Thank you.
David also leads a team of analysts that help provide insights into all the commercial property types in the market and submarket level. David also presents on market conditions and lenders, developers, brokers, owners, and is a frequent speaker at industry events such as ULI, Bisnow, IREM, CCIM, and economic development corporations. David began his career with CoStar up in Maryland, correct? Yep. Sure. And having previously held positions in tech and research firms, he has his bachelor's in political science from Johns Hopkins. So thank you, David. Thanks for being here. And Mr. Brad Raber is the market analyst for the Atlanta market and serves as CoStar's resident expert for Georgia. Mm-hmm. Brad is responsible for both market and submarket analysis for all of Metro Atlanta for all the property types. Brad presents on market conditions, just like David does, to lenders, developers, and to the CCIM chapter. Brad is a proud Atlanta native, having earned his Bachelor's of Science in Building Construction from Georgia Tech and an MBA from UVA's Darden School of Business. So Brad and David, I'll turn it over to you guys. Thank you.
Yeah, thanks. Well, thank you all for being here. I'm David Kahn. Thanks again for the intro. I'm going to start out today, get through these a little bit. I'm sure we'll go into it after. Here we are. Atlanta market update. All right, smooth transition. So the purpose of today is I'm going to give a background on the overall U.S. economy and how that relates to CRE, some really broad-based trends. Hopefully you can gather some major insights from that. And then Brad is going to talk about the Atlanta real estate market, so diving into office, industrial, and multifamily. So starting out, the U.S. economic outlook has been pretty positive. Last year was a strong year. GDP growth picked up. Going into each of the commercial property types, apartment, it was really a year of recovery and strength in apartments, so better than expected rent growth and better than expected demand, which is kind of rare this late in an economic cycle. Office, we're not building that much nationwide, and we're really not building that much spec, so the office market vacancies declined to single digits, which again, this late in the cycle, extremely rare. Industrial has really been the favorite child of CRE this cycle. Nationwide, incredible rent growth, strong demand stemming from structural shifts like e-commerce, but then also trade routes and port openings and dredgings. Retail, has probably been the weakest performer recently. All of the negative headlines are out there, but still, vacancies are relatively low nationwide. Rent growth has been subpar, but still positive. So we haven't seen much a crash in terms of retail. It's no retail apocalypse. It's just kind of plodding along, especially compared to the other CRE property types. So looking at GDP growth, it's been a slow and steady cycle. GDP growth hovering around 2% annually, a little bit upside or downside depending on the year. 2018 was right along that. We were looking at 2.9% GDP growth, above average for the cycle, but a lot of that was due to the fiscal stimulus, the tax cut act as well, and we expect that to peter off, or it's already started to peter off so far. This is the Economic Consensus Wall Street Journal, and 2019, 2020, a little bit slower growth, but 2019 especially, growth right along the cycle average. So we're talking 2 to 2.5%. Nothing to write home about, but still solid growth. And this slow and solid growth has been pretty good for CRE this cycle. Looking at employment growth, you see in the headlines, we continue to add jobs at a really strong rate. The most recent jobs announcement was relatively weak, but if you smooth that out over the past 3 months, it's actually right in line with the cycle average. So we continue to add people, even though unemployment rate is below 4%. We continue to add jobs at that 200,000 a month rate nationwide, which is just relatively strong. So you can see here the uptick in 2018. Again, a lot of that likely due to the fiscal stimulus, increased business investment, and stronger consumer spending. And all this we like to talk about. Everyone wants to know what the Fed's going to do. Is the Fed going to raise rates going forward? Of course, the market's baking in 0, possibly 1 rate hike this year. It's important to note that historically, we're still in a very low rate environment. Here's the Fed funds effective rate in the blue, and in the red is the 10-year Treasury note. So you can see, compared to the 80s or even 90s and the previous cycle, rates are pretty much at historically low levels. So again, that's low, slow, positive for CRE this cycle nationwide. Now looking at the 2019 outlook, just overall GDP growth, again, it's expected to slow moderately as the fiscal stimulus peters off a little bit. Job growth projected to remain strong. So again, even though this latest job numbers was a little bit subpar, we still project that 200,000 a month to sustain, and that should sustain demand for CRE. Inflation will likely remain subdued, low and stable, right around that 2% Fed target. Downside risks, of course, everyone's looking for that black swan event. We don't see something in the near horizon, but potentially trade tensions, a global economic slowdown, so nothing locally here, more of a European or developed economy problems could impact everything. And then financial market stability, values, equities are pretty high right now. So any kind of an imbalance there could have a broader impact on the broader economy. Now looking for CRE, the apartment market, again, it was a really strong year for apartments nationwide last year. Rent growth close to 3%, which this late in the cycle, very rare. We expect vacancies to rise because there's just a lot of supply. The good news is there's not a lot of single-family supply, so there's definitely upside in apartments as we continue to add people to the workforce and create households. There's good upside in apartments where we continue to add people at an accelerated pace and there's demand for those new units. Office market, again, most of the building, it's in your high office using employment metros, and a lot of it is built to suit, so it doesn't affect fundamentals in such a negative way. Rent growth expected to be moderate. Industrial, at least in the near term, it's all signs of go still through 2019. Obviously, the farther you go out, the more uncertain it becomes, but 2019 looks exceptionally strong for industrial again. And retail, again, slow and kind of steady, about moderate growth in the retail sector. And that's it for the overall economy, and I'll hand it off to Brad.
Thanks, Dave. Appreciate that. I would love for this section, I mean, since everyone here, I believe is based in Atlanta, kind of have some feedback. So if you have any questions or want a clarification on the way a particular slide is laid out, I'd be happy to answer that or kind of engage like in more of a dialogue, because that's how we get the most benefit out of this, and I think you guys will get more benefit out of that as well instead of a young lecturer here. So I will dive in and I'll kind of give the caveat that I'm born and raised Atlanta, Georgia Tech. I'm gonna try not to be a cheerleader for the city and kind of put on the more objective analyst classes. But I will say Atlanta's in a really great spot. Starting with job growth this cycle, Atlanta has been one of the big winners nationwide. We're competing with larger metros like Dallas, Houston, for really strong, consistent job growth, and even re-accelerating through 2018. Looking good in 2019. And naturally, with that much job growth, unemployment rate has ticked lower as it has nationwide. Atlanta has seen the local unemployment rate tick below 4%, which is a low that we haven't seen in the last 20, 30, 40 years. And a lot of that has been, again, we're competing against much, much larger metros on a gross job basis. So again, competing with Los Angeles, Phoenix, Chicago, and take note of who's on this total job formation, and we'll compare that in a couple slides to total population formation, and you'll see what kind of residents Atlanta is gaining, and kind of what that could mean for CRE demand going forward. The jobs that Atlanta has created really has been kind of a barbell of a lot of jobs at the white-collar, office-using level. So we're seeing really strong population growth. We're seeing really strong income growth. We are seeing demand for tech employees, again from the three major educational institutes in Atlanta. It is a large and deep labor market, so I think employers are really drawn to it. But it doesn't have a lot of the costs associated with other coastal urban metros. So with that, again, population growth really, really outperforming the national average, easily twice the national average for population growth. And recently that's really been accelerating. Probably going to do over 2% this year, while the nationwide average is starting to decline. And so again, Atlanta's top three for population growth. And the other metros that have seen really, really strong population growth are really all southern affordable metros, where you can bring in each job is going to bring likely a family with it, compared to metros like the Bay Area, where if you want to have a family, if you already have a family, housing costs and cost of living are going to be really, really biased against you. And so they there's a recent article in the New York Times about kind of the disappearing child of San Francisco. Again, a lot of that is tied to cost of living, namely housing costs. So I mean, this is really a nationwide trend. We've seen this really strong this cycle, but this really is 20, 30 years in the making. In orange, we have people that are, or metros that are seeing out-migration, and blue, metros that are seeing in-migration. And so people are opting to leave the very expensive New Yorks, Boston, Seattles of the world, and move to the Phoenixes, Las Vegases, Nashville, Atlantas. And a lot of that is going to be tied to housing costs. I am now of the opinion that, similar to the phrase that the rain follows the plow, really access to housing creates the job. And when you're looking to hire people, people who want to get on the housing ladder, that's significantly more doable in a metro like Atlanta, where our housing costs are a fifth of most of California. It's more than half of Seattle. For again, still very high quality of living, but your ability to either rent or really get on the purchasing ladder. And again, so on a multifamily side, we absolutely are a draw. You'll see Atlanta's down here with below the national average, and competing with other kind of more, I'll say classically liberal, kind of fewer barriers to entry like Dallas. Obviously, San Francisco, New York, Boston, very expensive, a lot of really high-end job growth. But that's actually going to be a big tailwind for Atlanta going forward. So we're going to dive into office, and I guess kind of real quick, any questions on Atlanta's macro overview?
Yeah, I do.
Yes.
When you're speaking Atlanta and Metro, how far out are you going? What do you where do the suburbs begin?
Sure. So CoStar uses the CBSA definition, which is 25 odd counties. So that's everything from the Alabama border, just south of Gainesville. Gainesville is its own separate metro, over to Athens. Athens is its own separate metro, and then north of Macon. Macon's a separate metro. So it's a fairly large plot, but that again, that's a BLS definition for the CBSA.
And jobs, you did speak about the white collar jobs
Mm-hmm.
being part of that. But what else are you looking at when you talk about job growth? For instance, just to kind of span that, I heard someone talking about, well, in prison we learned about bricklaying, we should learn that now. And so where does that go? And then so it's kind of the gamut of, and then one of the car makers going electric says, well, the other side of going electric is that once the cars become electric, then there's less need for employees. So what are you looking at when you're looking at job growth?
Absolutely. So kind of to the first point, the construction industry is still a smaller labor force today than it was at the peak. We're about 80% of the labor pool that was available in 2007. Whereas nearly every other industry, manufacturing aside, has rebounded to be a much larger labor pool than it was pre-recession. Construction just hasn't come back, and that's partly tied to migration. I mean, we have seen a lot of the Hispanic workforce return to Mexico as they've liberalized their economy. But then a lot of it is skilled tradesmen are simply aging out, and they haven't been able to backfill at the younger generation, people who didn't go to trade school or people who sought employment elsewhere.
And a lot of that was the single family boom of the previous cycle. That's where that set the bar so high for construction jobs that in a lot of metros it hasn't recovered that.
Yeah. And I mean, labor shortages probably are one of the largest drivers of construction costs going up at the pace they have been recently. But to get to the heart of your question, trade, transportation, and retail has been one of the biggest job drivers at the low end. Atlanta, and we'll get to this in the industrial section, really has become a true hub for goods coming from the coastal ports to the growing population of the Southeast. A lot of those roads go through Atlanta first. So we've seen unemployment drop really fast in the Douglasvilles, Clayton counties of the world this cycle. And nothing, another.
Yeah, just in your national and local numbers, do you have any feel at all as far as underemployment is concerned? What gap there may be there?
So
We talked about this yesterday.
Yeah, we talked about this stuff. But so looking at unemployment rate, the headline U3 unemployment rate below 4%, by textbook definition, that's essentially full employment. Looking at another layer of that, the U6, so the underemployed or the discouraged or what have you, that's actually below last cycle's peak as well, or the last cycle trough. So when it comes to bringing people back into the labor force, we're starting to finally do that. Discouraged workers coming back, even disabled or criminal records, starting to bring that back into the labor force, and still wage growth, even though it's picked up lately, it hasn't really accelerated at a strong pace. So we keep adding people, we keep adding more and more jobs kind of coming out of the woodworks, and inflation remains tame. That as the cycle goes on, that's more demand for housing and more demand for CRE. Yeah.
Okay, fantastic. So diving into office, Atlanta again was a real success story this cycle. We did overbuild through the pre-recession years, largely at a similar scale to the residential overbuilding. This tower is probably a good example of that. Was completely vacant when it delivered in 2009, 2010. But as corporations looked for, again, lower cost of doing business and access to Atlanta's airport, Atlanta has really boomed in terms of office demand. And so we have demand in blue here. And you can see really through much of the middle of the cycle, really strong as both businesses relocated and businesses continued expanding kind of once they fell on more firm footing. And then even this year, 2019 is the last on the chart here, we're going to see some of the best office using demand that we've seen in the last 4 years, which again, kind of this late in the cycle is surprising. But again, we have a lot of job announcements, a lot of particularly tech heavy firms choosing to set up large operation centers in Atlanta. So with that, I mean, the vacancy rate has been in a holding pattern here in the black line for the last 3-4 years, but we should see that tick lower this year. There's simply just not as much large vacant blocks of space as we've seen in previous Atlanta cycles. I feel like a lot of this room has seen the Atlanta that is in a lot of lenders and developers' mind, where people get really bullish this late in the cycle, a lot of spec goes up, but I think Atlanta really has matured. You can say that part, but I also think it's still kind of a dirty word in a lot of national lenders' mind. On the multifamily side, the cities with the best rent growth are Phoenix, Las Vegas, Atlanta, and Orlando. And those were really the housing bust metros, and so I think it's still in a lot of developers' mind. You don't want to be caught flat-footed here, but that's benefited today's landlords and today's developers as the city has matured. And again, supply really has been muted this cycle. This is a quarterly look at new supply, and that black bar is the average of the last 20 years. So in just the 2 boom years of 08-09, we saw about 9 million square feet deliver, compared to the last 8 years, we didn't even meet that 2-year threshold. So supply really has muted, and what has come online has largely been build-to-suit, particularly at the largest towers that have gone up have been, the Cox, NCR, State Farm is in the middle of their large build-to-suit, and they are actually part of the kind of fluctuations of that drop-off from 15 to 16. Because they are such a big player, big employer in Atlanta, and a lot of their moves have been lateral. But I don't know if you guys have seen their new campus, really pretty, connected to the MARTA up in Dunwoody, and is likely to be kind of a model for growth going forward. With supply being constrained and Atlanta, not being a secret anymore on a great place to do business with a deep labor pool, rent growth really has taken off, and that's kind of a two-sided coin of rents really were hammered kind of through the recession. I mean, it wasn't as bad as the national picture, with some metros having really big overhangs of supply. But then coming out, we've really dominated the national story. Again, particularly late in the cycle, 2018, 2019, we're still doing about twice the national rate of rent growth. And that's a combination of firms from California, New York, looking at Atlanta rents that are half to a third of what you're seeing in the Valley or New York City, and saying $50 is a steal. So that's who's creating the jobs. That's who's creating a really strong demand for high-end space. And again, the large blocks just aren't really available in the way that they have been in previous expansions, say like the late 80s or even the 2000s, when Atlanta started to feel some of the tech boom there. With this amount of rent growth, I mean, we are healthily above our pre-recession peak in rent levels across the metro. We are starting to see some amount of spec come online here. And so we have, in red, the available under construction, and blue, recently delivered and available. So we have seen that tick up higher in the last 5 years, which again is not surprising in the nature of the real estate cycle. But again, compared to where we were at the end of the cycle last time, still very modest. There's not the level of lending, there's not the level of people going forward without a single signed tenant. And so the projects that have been announced and are coming from deep-pocketed investors have seen really strong pre-leasing at the rates needed to justify the new construction. And so these are some of the new maps in Excel. I'm really excited to share them with you here. So this is what was currently under construction. The large projects really are concentrated in just a handful of submarkets. Central Perimeter is been a big beneficiary of this cycle, as firms are seeking both the executive talent of the northern suburbs, but also want to have some amount of millennial labor that has tended to choose more in-town locations or locations that have MARTA connectivity. And also Midtown's probably an even better example of that, where you do have a lot of really, really high education attainment, and also access to a tech workforce that does skew younger. For example, we had the Coda project come out of the ground and should be delivering this month or early Q2. They're already nearly 70% pre-leased. And I think they're actually holding some of that to actually be a delivered product, kind of hoping to capture in people who are waiting to kick the tires and really get into a high quality space that has the mixed ground floor retail, that has connectivity, that has a walkable environment. I think that's absolutely become, probably tired of reading the headlines recently, but that does seem to be a product of the next generation. I don't think that's going to slow down anytime soon. Just down the street, kind of to the build to suit narrative, Blue Cross Blue Shield has identified Atlanta as having a deep IT talent pool. They decided to put their own standalone IT headquarters in Atlanta with the ground up 3,500 square foot new build. Again, kind of capitalizing on the talent from Georgia Tech across the street, talent from Georgia State just downtown, and even Emory, which does put out a lot of graduates. I think there is probably some cause for concern in terms of the amount of proposed projects in the pipeline. Again, a lot of these have been able to wait and hold until they have a lease in hand to break ground, which might be a departure from a previous Atlanta. But a lot of these projects are from deep-pocketed investors and developers, and there could be a decided shift in how much supply is coming to the market and how much is going to be competing for some of these new tenants. So actually the interlock is in site clearing phase, and I believe they should be going vertical here in the next week or two. But they signed on WeWork for over 100,000 square feet, about a third of the building. And WeWork's obviously been in the news a lot recently. They should break 500,000 square feet in Atlanta this year, probably approaching somewhere 600, 700,000 square feet. And so, but they're still a fairly small player in terms of large tenants in the metro. They have spread around kind of from Central Perimeter all the way to downtown. And so, I mean, just kind of a quick poll: have you guys dealt with WeWork in any of your professional lines? I mean, in terms of, they still have the intent to expand rapidly. Someone?
Yeah, they'll go to 1.2 million square feet.
Wow, that's strong.
No, in various buildings. Some in mine, but.
Yeah. Obviously, they've got a really large financial backer in SoftBank. And I think they've stated that Atlanta is going to be one of their top growth markets in the near future. And so we'll see how they play out if there is a economic slowdown or a slowing demand for small firms in these spaces. Although they have been able to expand their model to a myriad of new lines, that we'll see how that continues to evolve. And then the 1105 West Peachtree project from CLIG really surprised me in how quickly it went from being proposed to being nearly half leased. And they're also in the site clearing phase right now. But this will be a substantial project, over 600,000 square feet. And we'll also have some mixed-use components of ground floor retail, hotel, and I believe a small amount of condos in the project as well. So with all that new supply that could be coming online here, again from financially backed developers and lenders, there is a lot of talent coming into the metro. Large employers, BlackRock hiring 1,000, Inspired Brands hiring another 1,000 up in Central Perimeter. The in-town Cobb around the Braves development has really actually kind of solidified itself as a somewhat walkable, somewhat urban feeling kind of corporate hub. Again, as firms are seeking access to the executives of Cobb County, but then still have the amenities from a growing millennial workforce. And so there is reason to think that even if a handful of these projects go forward, there are large corporates that can pay top dollar for new construction to backfill that new supply. Okay, moving into industrial. Any questions on office?
Has there been any more word on the Regions or Region Partners deal over there at the Capital City lot? Have we heard anything more about that one?
Yeah, they're good. They've got the money now.
Yeah, I mean, it sounds like they've got the three partners, and if they can get a lease in hand, I mean, it's an excellent location. Again, from what I've heard discussing with brokers, that a lot of tenants won't even open a discussion if there's not MARTA connectivity. So if you have it being at the end of the MARTA Bridge, it does seem like a project that could go forward pretty quickly here. Yes, ma'am.
What's happening at Rooms to Go and then China? Because there's new fences.
So it looks like Rooms To Go is just remodeling their store. I don't have any better insight there, so I don't want to talk about school here. And what was the other one?
China. The Brazilian
I'm not
steakhouse
familiar.
that stayed vacant for like 10 or 15 years.
Right. I don't know. I mean, I do feel that it's kind of crazy to me that the intersection of the two biggest roads in Atlanta is kind of a smattering of kind of small retail and bank space. But I do think there's absolutely a trend for, that Buckhead corner to really densify and become kind of a more walkable district. And the Buckhead Improvement Committee really has made that a position going forward, that it is going to be more walkable, it is going to be more livable for families, it is going to be more conducive to people who aren't married to the car.
I was going to say, of course, with Jim Cummings owning Flourish,
Right.
and then Jim Borders has everything south of there.
That's that could go vertical. Yeah. Okay. Let's. Industrial's gonna be fairly short because I really want to touch on kind of where Atlanta is again from a regional perspective. It has been a formerly again easy to build in metro, but we have seen just really strong demand as both e-commerce has picked up in importance and the port scene has really changed on the eastern coast. That is now serving a more active Atlanta supply hub. So we've seen against the national vacancy rate, Atlanta really has almost been cut in half over the last 10 years. Where there's a good chance that we'll kind of reach parity with the national rate, which is really, I mean, if you're from Atlanta, it's been so easy to add new supply, and some of the large markets like northern New Jersey, California, they're at vacancies around 2%, 3% because there's simply not enough land to continue expanding those supplies. So the fact that we've come down this far this quickly, I really think speaks to both the changing nature of retail industrial, and as those two product types kind of blend into kind of a single supply chain. And then also, again, just Atlanta incomes are rising, Atlanta population is rising, as well as our southern neighbors that we compete against, the Nashvilles, Charlottes of the world, and those goods flow through Atlanta first. So Georgia really has become a much stronger place in the national supply chain. The state of Georgia is the third most active construction pipeline for industrial, trailing just California and Texas, states that are 2 to 3 times larger than Georgia population-wise. And a lot of that is thanks to the Port Authority at Savannah has done a phenomenal job of making investments that have made it a more attractive place to do business. They've completed significant deepening projects so far that are now able to accept the post-Panamax size ships that are much larger, much deeper, and can carry significantly larger cargoes. They've announced a record amount of incoming and exporting supply for every month of like the last 30 thereabouts, and 2018 was a new record for them as well, unsurprisingly. So again, as trade from China, trade from South America opts to bypass bottlenecked western coast ports, a lot of that's coming to Jacksonville, a lot of that's coming to Savannah, a lot of that's coming to Charleston, and so Savannah has something like 12-15% of its current inventory under construction. It's one of the most active in the nation. But given that vacancies are still in the low single digits, there's really outsized demand for new modern facilities in the region. So with that, I mean, the industrial market is decidedly different from office. Developers are much more comfortable going vertical or horizontal with their product before having a lease in hand. And a lot of that's driven by tenants really need the space yesterday. So being able to offer a fully fitted out facility has given both lenders and developers confidence to move forward on a spec basis. But we are seeing just incredible record leasing velocity to backfill that space, within a year of it delivering on average. And even though supply really has ticked up, I mean, Atlanta and Georgia is very active nationwide. It's still fairly modest in relation to the inventory that's already existing. And I think that's a good thing. Again, the product type is probably most attuned to national GDP growth, and that spigot can turn off fairly quickly given how quickly it can go up. But it's most likely not going to be the huge overhang of supply that, even our most active large markets like I-20 West Douglasville is only about 6% of existing inventory. And again, compared to other high supply markets, which are closer to 15-20% of new construction versus inventory. So again, it's a fairly balanced market. And because of that, we have seen outsized rent growth in industrial. Again, in the year 9 of the recovery, the fact that we're still accelerating, we're still seeing rent growth over 7% in a fairly easy to develop metro is really surprising, but great, if you're a industrial landlord. And I have heard some rumor that some of that is we are actually running out of buildable sites that can accommodate the new supersize warehouses that were very much in fashion this cycle. I think people are starting to see some amount of pushback from a little bit of NIMBYism in some of those fringe cities that don't want to see the amount of truck traffic coming on. And then also we're seeing some amount of people are saying the trees don't grow to the sky. Maybe the spec scene needs to calm down slightly to before we go forward again. But again, so this is blue is existing, purple is under construction, and orange is proposed. And the fact that this is so even, like not one of those, particularly the under construction or proposed, doesn't really dominate the map. And I've said repeatedly, the fact that we're in year 9 and this isn't just a sea of orange is really surprising to me, given the tailwinds that Atlanta has behind it. Given the kind of changing nature of industrial space, I think this does show a level of restraint for the region and is going to kind of bode well through any kind of economic slowdown we see in the future.
Excuse me, just before
Yes.
you leave that slide. When you say propose, the first time I've ever had this question, are you speaking of a situation where the land is in contract, or property is in contract, and the buyer is going through a due diligence period? Are you speaking of a period where the sale has actually taken place and they have plans to go forward with it?
So this should be tracking everything where they filed a permit or filed a review for permit. So it is a fairly expansive definition of what we're calling proposed. But again, it's fairly mild. I mean, in some of the really big players, Amazon has 2.5 million square feet that they've put out there for kind of years. But there are really strong drivers behind some of those new large spaces. Yes?
And so, these are all about following the interstate corridors, but when you're saying that these are planned for, as you find some of these other retailers like the Targets and the other, moving ahead to the same day delivery service.
Right.
When they're staged, are you finding these kind of trickling into some of these secondary and tertiary markets so that they can deliver, so that they're timed this way as well, because they're not all going to market at the same time? Or did your research on your findings?
So I can't say that the timing of when developers bring a certain product to market is tied to a particular retailer demand. Although I will say, as kind of one data point, our most downloaded industrial reports are the in-town industrial, so the Norcross, the Fulton Industrial Boulevard, where they'll put a 1 million square foot big bomber center out in Jackson, Georgia, and then also seek a 50,000 square foot space that is in town, close to the end consumer. So it is kind of a stepping stone approach where they'll get the big trucks to the large center, and then if it's staying local, then that will be tied into a last mile delivery center. Yes, sir.
What's going on in Adair's?
I probably couldn't speak to that exact project. I mean, so like is Adairsville kind of up near Calhoun?
Just south of Calhoun.
I'm not familiar with that project exactly, but we are seeing a lot of the really large projects just be pushed further and further out of the city center. I mean, kind of down 75. I mean, that structure is almost in Macon. Jackson County has actually been like one of the biggest drivers of industrial product. It's basically doubled in size this cycle. And if it was an Atlanta submarket, it's its own separate thing. It would be the second most active submarket in Atlanta, behind the airport submarket, which is already 100 million square feet. So it's really come online. Again, I think a lot of that product is coming from the ports and then stopping in Jackson before going to, you know, the Charlottes of the world. Yes, sir.
Do you have an idea how much of this kind of new demand is driven by e-commerce, either as a percentage of whole here or relative to other markets?
So we had a national slide for a while where, I mean, e-commerce still is a fairly small amount of consumption today. I think it's still in the single digits, but it is obviously the source of pretty much all retail spending growth. So
Nationwide, it's about 50% is e-commerce for industrial demand. So net new industrial demand, about 50% of that is e-commerce nationwide. And the major logistics markets, I would say, are pretty close to that. Yeah.
Okay, anything else before we hop into multifamily? Multifamily has probably been one of the more interesting product types this cycle. For Atlanta in particular, it's in the news a lot. I think people are afraid of the number of cranes that are in the sky. But I do kind of want to say that's really a product of how visible product is today versus how Atlanta has grown previously. And we're still most likely underbuilding kind of relative to historical norms. Atlanta has, again, with the amount of job growth that we've seen, the amount of income growth that we've seen, it has been one of the stronger markets for multifamily supply nationwide, which is unsurprising to kind of service those new jobs. So we have supply in orange, demand change in blue. Last year was really standout, and I'll be honest, as someone who's rented in Atlanta for 10 years, at the prices that are being commanded today, I was really shocked that we saw that amount of demand in absorption. But again, that's really just a testament to the types of jobs that Atlanta is creating and kind of how the multifamily side mixes with single-family demand and where pricing has changed in Atlanta this cycle. So we have more or less mirrored the national vacancy rate decline. We're again, a systemically higher metro, again, just because it's a fairly easy metro to build in compared to New York or California. But again, it declined last year, and this year should be a fairly modest supply pipeline. Well, we'll get into that in a second here. And so again, with the amount of demand that we've seen, the amount of income growth we've seen, Atlanta does have some of the best rent growth in the nation. I had mentioned previously we're in the top 5 currently for major metros. Again, job growth is strong, supply has been fairly middling. Rent growth has re-accelerated. We're about 5% today. And again, that kind of rent growth this late in the cycle, still accelerating, is surprising if you've been watching the space for a while. And again, a lot of that has been driven by affordability concerns. If you're looking to take a job and same wage in New York or Atlanta, you'll move to Atlanta if given the opportunity. It's just going to eat less of your paycheck from day one. Not to mention the kind of lower tax burden, the ease of doing business here. The supply, again, has been largely dominated at the high end of new construction. Something around 85 to 90% has been 4 and 5 star in Atlanta, which is a decided departure from our existing housing stock. This year, we're probably going to see 4 and 5 star gross supply overtake the 3 star Atlanta, which was a largely result of huge supply additions in the 90s and 2000s. But today, in order to justify the construction costs that have been marching up at 1% a month, that new stock really does need new supply. So that's given a huge tailwind to 3 star and 1 and 2 star supply, which have been the big beneficiaries of that and kind of increasing gap between what's affordable given the incomes here. So we are seeing concessions tick higher, but again, that's really at the top end. 4 and 5 star has gotten very competitive. If you're coming out of the ground today, you're most likely going to have to offer a month, 2 months of free rent or some other inducement to get someone in the door. I mean, they are asking really strong top line rent growth or top line rents, but they've had to kind of to get people into the shop, really offer some rent concessions. But that's, again, 3-star has a really long runway before they're less competitive than the 4-star and 5-star supply that's coming online. Through much of the metro, a 3-star is a third or more cheaper than a new 4 or 5-star product. And a lot of the 3-star supply has been renovated. So, I mean, it's not a significant quality gap that we're seeing. It's just the nature of what Atlanta has been offering and what the climate is for new construction costs. And then kind of where that rent growth, and again, this is tied to new supply, has been concentrated to the urban core. So Midtown, Buckhead, Central Perimeter does have an outsized amount of supply coming online. And so that has muted rent growth there. We've seen really strong supply in that, that orange ring of the suburbs, kind of outside 285, has been really strong. And even some of the exurbs, if you're in Kennesaw, Canton, they're at almost 7% rent growth. So there's absolutely still jobs out there. There is still affordable rents out there, and so that's given landlords the ability to push rents for much of the last cycle, including last year. There is some concern that this strong of rent growth may not be viable, indefinitely. Rent growth does track income growth on a slight lag. So we have seen income growth decelerate over the last 12 months. And so, with rents still growing, that's going to create some tension on how long can that rent growth continue before, they right size for where incomes are. So that'll be something to be debated out over the next year or so. Looking at supply, again, my favorite chart here. This is what was delivered in 2018. And so it's been really concentrated in the tower, high-rise living in the urban core, in Midtown, in Central Perimeter, in Town Cobb. And to a point of that, again, those of you from Atlanta, they're finally building new multifamily in downtown, which probably wasn't, even on any developer's radar even 5 years ago. But the fact that, Post Centennial Park put 430 units down there, really strong rents comparable with Midtown. And they've seen fairly strong leasing, around 17 units per month. I think really validates it as a standalone submarket, and kind of the amount of, the office vacancy in downtown is among the lowest of Atlanta's in-town markets. I think it's kind of finally poised itself for a viable, attractive place to both live, work, and play. And I think the Post project has validated that. Just down the road here, over in Buckhead Village, Hanover has also seen some fairly strong leasing, about 19 units a month. But they've definitely relied more on the concession lever in order to achieve that rate of lease up. Again, but 350 units, 32% vacant. They should stabilize this year, but again, they're going to really rely on the concession lever to achieve that. Buckhead really has been a developer favorite this cycle. It's consistently led the metro in new supply. It's a fairly easy place to get projects approved. And there's still fairly large parcels that are available for the amount of high-rise living that has been the kind of choice for developers. But again, it's been in town for much of the cycle. Midtown, East Side, even Cohen Galleria has, again, kind of with that office story, become a much more walkable urban destination in its own right, despite not having MARTA access. And even going forward, Buckhead really does lead the supply pipeline. And again, urban. We are seeing more suburban construction going forward, and this is the current under construction pipeline in blue. We'll see about 10,000 units deliver this year. And although there are kind of more projects going farther out, the 575 corridor has been a big winner in current projects. It's still 75% urban supply. And I think a lot of that's driven both by, at the top end, empty nesters who are looking for a lower maintenance lifestyle. We are seeing outsized demand. The tower right here is, 3 bedrooms for about $9,000 a month. that's not a millennial renting that. That's a retired family looking for a little bit less space. But also again in town walkability. That a lot of that is a younger renter. Kind of in a surprising quirk. I mean, you mentioned Novair earlier. One of the largest projects under construction is South Lawn. I mean, if you guys are familiar with Novair, really the king of high-rise in Atlanta. And the fact that they're going mid-rise suburban at this point in the cycle is really interesting and kind of where some of the smart money is going. But a lot of kind of ex-urban town centers that have seen a lot of attention this cycle. Kennesaw has been upgraded. Canton has been upgraded. Lawrenceville is getting a really large makeover right now. Novair is providing a lot of that multifamily component. But also Sandy Springs has also kind of become grown up from its suburban roots and is now seeing more urban product types. But also they're able to develop there at more agreeable rents, right at $2 a square foot, which isn't, competing with some of the, Midtown has seen some of its first projects achieve $3 a foot. Midtown's, or Buckhead's closer to $2.50. It is for a different product and a different kind of renter. And then you'll also notice that most of the new supply really has been north of 20 this cycle. But kind of throughout Atlanta, renovations have played a really big role in kind of refreshing both some what formerly was obsolete, but because of the demand at the low end for, Atlanta probably hasn't had an affordability crisis really until this cycle. But we're seeing units really pop up along some of the major employment nodes for the trade, transportation, retail jobs, around the airport, kind of through the south of 20 neighborhood. And we're seeing a lot of activity out there. And that's like a lot of where the investment volume is coming from a lot of these small sub 200 unit deals. So we're going to wrap it up there. Atlanta's, again, I'll say in a good place. We're still seeing strong job growth. We're still seeing a lot of activity. We're seeing fairly muted construction levels given how late in the cycle we are. I mean, there's not likely, even in the event of a job growth slowdown, the supply overhang seems to be fairly muted compared to previous booms that Atlanta has built through. So kind of with that, again, thank you so much for your time today. If you guys have any questions, absolutely, Dave and I are a resource here. Again, kind of any final questions today? Yes, sir.
Oh, yeah. In the past few years, I've always used the baseball analogy. We're in the 7th, 8th, and 9th inning. Are we in extra innings now? Or are we?
I don't know. I mean, this is a very popular question. So I'm of the opinion that as long as construction levels remain muted, as long as leverage levels kind of remain, around the 65%, 70%, we have seen the amount of leverage in the system really come down, both as, large banks have been mandated to hold, or not allow as much, debt to value on their loans. We have seen some alternative players pop into the space who have provided a lot of the more creative financing. I personally won't make a judgment call on something like a macro picture, but I do think should the nation go towards something where there's fewer jobs today than tomorrow, Atlanta still has a lot of tailwinds. If you're looking to cut costs, if you're looking to afford a house, if you're looking to get on a ladder that's really is not available in some of the super high-tech metros, again, in California, in Boston, in New York.
The difference now, especially in the South, is traditionally we've always had the affordability advantage, but now we're adding more sense of place areas in places like Nashville, Dallas, Atlanta, things that we didn't have 15, 20, 30 years ago. Plus the just the concentration of highly educated workers has continued to grow. So looking into the next downturn, whenever that comes, how steep it is, what industries it affects, who knows? But coming out of that, because we're not building as much as we have historically, and we have all those macro trends, we're better insulated or we're more likely to come out of it more unscathed than we have been in previous cycles.
Yes, ma'am. My favorite.
Do you, as you're looking at these things, look at the impact of the unusual or the niche as in the movie industry, the impacts there, and how that's affecting the economy in Atlanta. We'll go with that. And there was and the other one is the impacts of tax credits, because those, you say 10 or 15 years ago, things that didn't really have strong impact. Do you look at those?
So, I mean, the movie industry is absolutely a win for Atlanta and win for Georgia. I mean, I think they filmed every single Marvel movie of the last 10 years in Atlanta. If Georgia was a standalone country, I think it's the third most active movie production locale, which is really incredible. I mean, that's even competing against Canada and British Columbia, which has certain tax credits. It's absolutely been a big driver south of town. We're around Pinewood Studios. There hasn't been a lot of the follow-on product, although there are some rumblings of adding more retail there, adding more multifamily down there. There are some constraints in building in Peachtree City and Noonan, but I think it'll be a big driver going forward.
Tax credits, just tax credits in general, not specific.
Right.
I'll touch on that. So just in general, I was actually I used to cover Dallas-Fort Worth for 4 years, and I got to speak with one of the heads of the regional chamber down there. Said every economic development entity has had to up their game because of the Amazon deal recently. So they have tax credits, everyone has their program, every municipality has their own master plan, but that Amazon push is kind of forced everyone to up their game a little bit, so I wouldn't be surprised to see more activity in terms of that as an economic development tool going forward everywhere.
Yes, sir, in the back.
I know you touched on retail briefly, and you might guess that I'm a retail kind of guy. Any major insight points on retail as it relates to land costs in Atlanta and even surrounding counties and
Sure.
cost of land, cost of construction, and then the retail tenant saying, well, that rent per square foot's a little too high. I mean,
Right.
Any dramatic shifts that you see in the retail side of things?
I mean, I'll say dramatic in as much as we're building 1/10 of the supply of just the historical average in Atlanta. I mean, not even from the boom years. We're building 1/10 of the historical average, and I think a lot of that is the demand from other construction users in office and multifamily and industrial. Retail is the lowest on that pecking order in terms of what they can command in rents. So they are absolutely getting pinched on construction costs. And also, I think just a change in land development where if you're a big strip center or Publix anchored shopping center, going out to Dawson there's just not the demand for residential units out there. So that model is going to change pretty significantly from what was more common in the 90s and 2000s. And so I think Atlanta has one of the highest amounts of retail per capita. You could argue that we're over retailed, although I don't see a tremendous shift or a fall off at any point. I do think at the kind of B and C level, you're going to see a lot more adaptive reuse. You're going to see a lot more non-traditional users in that retail. And so I think a lot of the malls in Atlanta have already been kind of picked out for new uses for either office or for being white cleaning, being kind of high density residential. I mean, even Phipps is probably one of the strongest retail properties in the nation, and they still tore down the Belk and are going to add hotel, restaurant, and a gym. So I think that industry is in flux, but because supply has been so constrained this cycle, they're not going to suffer from exuberance where they have previously. Yes, sir.
What are your thoughts about infrastructure? I mean, at what point in time do we start choking ourselves?
I probably don't have a CoStar opinion on that, but as a resident, I think that the political winds have shifted to more acceptance and more demand and more of a realization that as we mature as a city, that mass transit is going to be a bigger part of that. And even seeing some of the suburban municipalities, if Cobb is agreeing with Gwinnett that they're going to do a, bus rapid transit system at the north end, that shift really surprised me, and from kind of where we were 10 years ago and seeing some of the T-SPLOST measures fail, I do think that there's going to be increased demand for particularly multifamily and office that do have MARTA connectivity. And I think as the SunTrust Park fills out, as Northern Gwinnett fills out, there's going to be demand and acceptance for bond issuance to extend the system and really densify around those stations. I think that's absolutely a trend that won't abate anytime soon.
Frankly, to me, it's the biggest headwind here locally. It's infrastructure. You compare the highway system to other southern cities, you could kind of spread out, especially in Texas, for example, go out into prairies, and here you have more land constraints, and the existing highway system is just not adequate for the growth that we have and the growth that we're going to continue to see. So definitely need to get out ahead of that game if we're going to remain competitive with some of these other major relocation hubs.
And I do think on not just traffic. I mean, the amount of infrastructure that's gone into kind of our wastewater management. Both if that's a park that can handle stormwater runoff, if that's more reclamation plants. I think our leaders actually have fairly done a good job of building that and selling that to the public. Because I think those are the kind of two big bottlenecks. If we run out of road and run out of water, that's going to stop growth kind of in its tracks. Okay?
All right.
All right, thank you guys so much.
So real quick, just want to thank CoStar again for hosting us. Very kind of you guys to have us here. Just keep an eye out for two quick things. The first thing, as I mentioned earlier, you guys will be getting an email on the member benefits, affinity benefits that you guys enjoy as CCIM designees, so keep an eye out for that. And then the second thing is in April, we'll have our sponsorship appreciation at Ansley, again, what we're planning. So we'll be sending you more information on that program for April. So thank you guys. Thank you for being here on a Thursday. Thank you again to CoStar. You guys have a good afternoon. Thanks.